Critical Man Pictures presents the Forex Video Training Series. Orange Belt Course, Intermediate Japanese Candlesticks, Simple Patterns. We introduced you to Japanese candlesticks in previous lesson, and now it's time to explore them with more detail. The Bullish Engulfing. This pattern is most valuable near support. The Bullish Engulfing is one of the more obvious two-day bullish reversal patterns. The formation reflects buyers overtaking selling strength and often precedes a continued rally in price. The smaller the first day's candle is, and the larger the second day candle, reflect uncertainty in the market's trend. Thus, the smaller the candle on the first day, the better the chance of an end of the move down. The second day bullish candle move acts to confirm the reversal of the move down. A big blue candle on the second day reflects a strong rally and a better chance of the reversal. Entry would be at the open of the next candle after the formation has been completed, with a protective sell stop below the low of the bullish engulfing formation. The bearish engulfing. This pattern is most valuable near resistance level. The bearish engulfing, like the bullish engulfing, is one of the more easily recognizable sellers overtaking buying strength, and often precedes a fall in price action. The smaller the day one candle is, and the larger the second day is, the stronger the potential for a reversal. Small candles reflect uncertainty in the market's trend. Thus, the smaller the first day candle, the better chance end of the move up. The second day bear move acts to confirm the end of the move up. A bigger red candle reflects a strong sell-off and the better chance of a reversal. Entry would be at the open of the next candle after the formation is completed, with a protective buy stop placed above the high of the bearish engulfing formation. The piercing cloud. This pattern is most valuable near a support level. The market continues the downtrend on the first day as candle 1 closes down. By the second day, buyers take the price up, so the close is near the open of the first day. Most traders view a lower low on the second day as better, since the stronger the selling after the open, the more buyers are able to push the market back up. This formation suggests that buyers have begun to take charge of the market, and sellers have been shaken out by a sudden loss of bearish momentum. Uptrends are common after this formation, as more buyers confidently enter the market with a clear protective stop level just below the lows of the formation. However, some traders wait for further confirmation, regardless of how far the piercing line penetrates the second day. They would look for another up day and buy on the open of the fourth candle. Protective stops would then be placed below the lows of the formation. The dark cloud cover. This pattern is most valuable near resistance. On the first day that a dark cloud formation begins to form, the market continues in an uptrend towards resistance. By the second day, sellers take price down to close near the open of the first day. Traders view a higher high on the second day as better, since the stronger the rally after the open, the more sellers were able to push the market back down. This formation suggests that sellers have begun to take charge of the market and buyers have been shaken out by the sudden loss of bullish momentum. Downtrends are common after this formation, as more sellers confidently enter the market with a clear protective stop just above the highs of the formation. However, again, some traders wait for further confirmation, regardless of how deep the dark cloud cover penetrates the second day. They would look for another day of losses and sell on the open of the fourth candle. Protective stops, of course, will be placed above the high of the formation. The shooting star. This is most valuable near resistance. This bearish candlestick formation appears when the price of the currency pair has traded well above the opening price, but closes below the opening price. Buyers have succeeded in pushing price up quite a bit higher during the session, but were not able to sustain that level. Therefore, it is probable that price action may decline in the near future. To be considered a shooting star, The formation must be in an upward or bullish trend. Also, the distance between the high price and the opening price must be more than twice as large as the shooting star's body. Like all candle formations, this formation becomes most effective when it appears near a resistance area, resistance line, or resistance zone. Hanging Man. The hanging man is a bearish candlestick formation that forms the top of an uptrend so that the close occurs near the open. The strong sell-off, however, is taken as an indication that bullish momentum could be fading and that sellers may be taking over. The color of the candle can either be red or blue. The hammer. This pattern is most valuable near support. The hammer is a bullish candlestick formation that forms at the bottom of a downtrend. A hammer will occur after the currency pair has been trading lower and declining for a period of time. Through the course of the candle, the price will trade lower than the opening price, but will strengthen to close higher than the open. Like the hanging man, the hammer can either be red or blue.